Well, we've just seen the US CPI number coming out, and let's just say it is spicing up financial markets. Go back to January, had 7 rate cuts being priced in by the end of the year from the Federal Reserve. We're looking at less than 2 at the moment. In fact, with such a strong US labour market, with base effects likely to kick in, and obviously with a US election coming through in November, we question whether rate cuts this year in the US are actually more a 2025 story. What does this mean all for US equity markets? Does we suggest that we're going to see a stronger US dollar? What does it mean for gold? We also look at the geopolitical issues that are plaguing markets at the moment and ask whether or not we could see $100 in the crude price and what that means for financial markets as well. These are fascinating times to be trading financial markets, and this is the trade-off. Hi there, my name's Chris Weston. I'm head of research at Pepperstone. In 2 seconds, I'm going to bring in Blake Morrow from Forex Analytics. But before I do, obviously, many of you will be familiar with the format of our show. But for people who are watching this for the first time, I want to give a quick introduction about what we're trying to achieve here on the trade-off. So we're going to break the show into 3 distinct sections. Topical Thunder, where we debate the hottest topics that are going through financial markets and ask, what is the trade? We then look at that as a setup, where we look at some technical setups at the front of mind and getting a lot of attention, and we ask where's the direction of travel and where are the probabilistic situations in markets. We then go into play of the day, where Blake and I will give a recommendation or a thought that we've got at the moment, or trades that we're actually looking to take our trade ourselves, and actually look at those in the market as well. So with so much going on in financial markets, let's go straight to the first section. Let's go to Topical Thunder. Blake, welcome, buddy. Thank you for joining the programme today. I hope you're doing well. Obviously, we've just seen the US CPI print coming out. It was hot. I mean, there's no doubt bones about it. We've seen the third upside surprise that we've been seeing. The core services numbers were hotter. We saw the core number at 0.4% if we round that up. The super core number that the Fed look at very closely, core services ex shelter, grew to 0.65 of 1%. The market has come alive. You've seen one rate cut being priced out by the end of the year. 2-year treasuries have moved up pretty sharply on the back of that. The dollar's reigned. What did you take out of this? Are we now looking at a situation where financial market volatility has to increase? The dollar goes on a one-way tear because of exceptionalism. Are rate cuts, a 2025 story? What have you taken out of this most prominently?
Well, we've talked. Well, first of all, yes, the numbers were very Paris Hilton hot. Very Paris Hilton hot.
Is that your benchmark?
So that's hot. And the fact of the matter is we've talked a lot about U.S. exceptionalism never really going anywhere, but really coming back into the fray. And I think that's what we're going to see right now. Now, obviously, as we move through Topical Thunder, we're going to go into the European Central Bank. And I think that has a lot to do with future price action of the dollar as a whole. But right now, those numbers were hot. And the market came in with this idea that disinflationary pressures were still going to be prevalent. Well, as we can see, it's been prevalent around most of the world, minus the United States. And everybody came in today thinking, selling dollars, even as rates went up yesterday, as yields went higher, people were like, we'll just sell the dollar into the CPI number. And then obviously everybody was wrong-footed today. So I think from a position point of view, it could really spark some more dollar buying, especially following the ECB tomorrow, which is a whole nother topic we're going to get to here in a second.
But I just want to jump in because the data now is pretty light on the calendar until we get to May. And we've got to be thinking, right, why would the Fed rush? I mean, look, the labour market's super strong. Q1, they average, payrolls average is 276,000 or so. If we go into that June, August period of last year, the month-on-month changes in inflation was so low that's going to be it's going to impact the year-on-year effects coming forward. So base effects are going to mean that inflation going forward is going to be very, very hard to go lower. And then, of course, when it's very unlikely we're going to see a rate cut in September just before the US election. So why they should be in a rush? I mean, it just feels right now that a rate cut is not going to happen anytime soon. There's no reason for the Fed to rush this, right?
There is no reason. And then the next issue is going to be the political issue that's going to come up. It's going to come up, and we're going to be talking about this in the months ahead. And so the Fed's kind of stuck. They're in a little, stuck between a rock and a hard place here. As far as if they want to act, they need to act soon, but they can't. We just, because of the data we got today, because of the jobs report we got on Friday, and you saw those jobs numbers, they were strong. Everything was strong.
Well, it froze open the idea of brewing policy divergence from central banks, which creates volatility, and it creates trends in FX markets, which is fantastic, right? We like that.
It sure does. And if you look at the compression of the euro, really, we've been stuck between 107 and 110 for so long. And that's going to be one of our topics that we'll be talking about here very shortly. So let's go ahead and move things along, Chris, and let's talk about the European Central Bank. That is, a lot of you are going to be watching this, as we're releasing this show, but some of you are going to be watching it in European hours before the European Central Bank. And we do have the ECB meeting tomorrow. I know they're going to set the stage for a June cut. That's already kind of priced in. That's what the market's expecting. But are we going to get June and then maybe a follow-up with July? And is Christine Lagarde going to hold her cards close to her chest, or is she really going to lay out a plan moving forward with the ECB? And again, the whole reason why this is so critical is because when you're talking currencies, and you saw what the dollar did today, the dollar broke higher. We got to levels that we hadn't seen in I think a couple of months, with the dollar index breaking out. But more importantly, the euro dollar slumped towards that 107.50 level where we currently trade, and really much below here really opens up the door for a lot of downside. Now, I personally believe the ECB is not going to be as dovish as the market expects. People keep telling me every time I talk to somebody, they're like, well, how can the ECB be hawkish? I can't say they're going to be hawkish, but I still think that they're going to be very monotone, if you will, and not give us a lot of hints. And if that is the case, maybe the euro gets a little bit of a bounce as a result, because they're just not as leaning so dovish that the market's expecting. What are your thoughts with the ECB going into tomorrow, Chris?
Yeah, I think I don't see any reason for them to be dovish. I mean, I agree that they're going to continue to guide to a June rate cut, but the fact is now it's looking more like that the Fed are going to hold off this year. They may cut again, but it really obviously depends. But I think those base effects are going to be a major issue in the US. And you're going to see a situation where policy divergence grows. So I really don't think that they want to be committed in any. They're going to be very vague in their outlook. They're going to continue to guide to June and continue to beat a very much a data-dependent drum coming forward, and that's going to be the issue. But yeah, I think what's happening with the euro now is that you are seeing the premium for US Treasury yields relative to all parts of German debt rising to big levels, year-to-date highs. And that incentivizes people to want to be long US dollars because the yield advantage is there. So those yield spreads widening is a really big part of the fundamental effects story, and that's something we are looking at very closely. So do we see something that turns that around? I'm not so sure that's going to be the case. And so, I still think that's going to support the US dollar. I think the euro dollar rallies are there to be sold because those yield advantages is very much growing at the moment, and that's creating a relative value trade to be short euros against the US dollar. So I think, for technical traders, you probably wouldn't be looking at those yield divergence that's taking place. But what we're seeing now is really, really, really important, as is what's happening in Japan. And also China as well. I mean, we've got to look at that. The fact that the PBO, and that's sort of off topic here, but the PBOC are keeping the yuan very stable to the US dollar. And as the US dollar is strengthening, what you're seeing is the yuan on a trade-weighted basis getting stronger and stronger against all these other currencies. That means effectively they're importing deflation when they've already got very low inflation. That doesn't sit well with me. We've got to keep an eye on what's happening to PBOC. Slightly off topic there, but these are fascinating times in FX markets. If the Fed are not going to cut this year, it does have huge implications for financial markets, I reckon, Blake. And I think that's probably a good time.
That move right here, Chris, is, I'm sorry, I didn't mean to interrupt. That was a lever, because that was one of their levers that they might pull.
Yeah, well, I want to bring in the dollar because I know this is your world as well. And I mean, you've probably been speaking to people about this all day long. And you brought out an interesting point that people, went into the CPI, that a lot of people were going in short. And I think that was certainly the case when in the institutional world, in leveraged funds and real money, our clients were slightly long of US dollars on a net basis across the G10 currencies. So they've done all right on the back of the move that we've been seeing on a whole. But the market was a little bit short of US dollars. But I think now, as I said, that dynamic is we do have the US data has been coming in hot. If we look at surprise indices, which measures US data relative to expectations, it has been consistently becoming better. We've got US manufacturing numbers, after 15 or 16 months being in contraction, now in expansion territory. Something we are going to be watching in the next ISM manufacturing number. Continues that push up. But we are seeing data coming in hotter. The labour market looks super strong. We've got base effects kicking in. We've got an election later this year, and policy divergence is really quite manifesting now. So the question is for me is, are we about to see a one-way trend in the US dollar? Not just against the Swiss franc or the yen, for example, but on a broad basis now, euro, sterling, stocky, knocky, all these currencies. Are we going to see a one-way trend? What's the probability here for you, Blake?
Well, considering the fact that we hit new highs for the year and we're trading at levels that we haven't seen since October or November of 2023, it looks bullish. And like I said, I think and you just mentioned, I think the positioning is really poor. There's so many people leaning into dollar shorts, and you're right, policy divergence. We moved as a whole, worldwide, globally, we all moved rates higher together. Now that we've done that, this is where the divergences start. And as an FX trader, this is one of the things we talked about going into 2024, especially when we did our end of year special here on the trade-off with Michael Brown. One of the big showcases was policy divergences, and we are finally there. It took us a few months, but we're finally there. And this is where volatility will really start to pick up in currency. So I think the dollar looks really good. I'm sure you're going to point it out a little bit later, and you guys make sure you stick around for this. Sterling looks vulnerable. Euro looks vulnerable. Dollar yen could get upended because of intervention, which we'll I'm sure we'll talk a little bit about yen, but that's just a very small portion of the dollar index. And you have to imagine that all of those other currencies that are matched up against the dollar, you could see the euro really come under pressure if the euro yen buckled, meaning if the euro yen fell precipitously from where we currently trade, which there's a double top if you guys are looking at technicals. If it starts reversing, that's going to weigh on the euro as a whole, euro dollar too. So we could see a one-way traffic in the dollar minus everything but the yen, and still be pretty much one-way traffic in the dollar on everything else.
Yeah, I think one of the things that I'm going to set this up really nicely for you now, Blake. But one of the factors that has caused such low volatility in FX market is one, the PBOC have suppressed it. Bank of Japan have been trying to suppress it. But this synchronicity that you talked about in policy, everyone's moving, they all raise rates at the same time, they all look like they're going to cut rates at the same time, caused yield spreads to be fairly well contained in FX volatility. If you change that dynamic, and certainly if you see the Fed doing something that's different from everyone else, you cause trends in yield spreads, and you cause a one-way move in the US dollar, which will have massive ramifications for emerging markets, for FX, for equity markets, certainly the Hang Seng and markets as well. I personally hope that happens. I'd love to see it. Obviously, we can't predict trends, but that's something that we are at a point now where it could happen, and it needs to be on the radar there. So synchronicity, or a lack of it, or a change away from it, creates volatility. There you go, Blake.
All right. And that takes us to our next topic, which is volatility. And, one of the things and one of the points I wanted to make by this particular topic, Chris, is that I think the market has been asleep at the wheel. And I think we've all been very aware of that. And you notice the title here, "'Twas the calm before the storm." It was the calm before the storm. I don't know if you saw the MOVE index. Obviously, it was on the move. Oh my, that's a dad pun, by the way. If you're a father, you totally get what I'm saying. The MOVE index really went on the move today. It looked like it was breaking down, did a complete 180. So high volatility in fixed income space. You're seeing yields rip. Bonds are just creating. That happened predominantly after the 10-year auction, which we have a 30-year auction tomorrow. A lot of issuance hitting the market, which means, especially here in the U.S., yields are probably going to have to continue to go up because institutions need to find buyers for all of this paper, and government needs to as well. So you got move index ripping. You got the VIX that's peeking its head up around 16. We start getting above 16 and a half, 17. That VIX is going to be in breakout territory, and that's when we start getting towards 20. And 20 is like that benchmark that people really start to go.
Bring it to me.
Yeah. Yes, bring it. Let's bring some volatility. But we get above 20, and that's when people go, hold my beer. You know what I mean? And
people want volatility, and then they get it, and then they can't handle it. Well, some people can't handle it, but
like, please, I just want to be able to sleep for more than an hour at night. But look, the market has been asleep at the wheel all of 2024, and I think we are at that inflection point today. So I'm glad you all are listening here for this. Chris, what are your thoughts about volatility?
I hope it comes. Bring it on. I'll tell you one thing that I saw. Did you see Paul Mulvaney's trend following his returns this year from his global macro fund that he came out with?
No, I haven't.
One of the big hedge fund. He's just come out with his annual returns, 124% year to date. The guy is a purely systematic trend follower. He buys breakouts. He's got a win ratio of 20%. So 80% of his trades are losing trades, right? 124%. He buys breakouts. He rides the winners. He cuts the losses. Simple as that. Obviously, there's a lot more to it. 124%. But he works on volatility, right? And he captures it and he holds those moves. For anyone who's wanting to get into the idea of the secret sauce of trading, you've got to go and have a look at his statistics. He buys breakouts. A lot of breakouts fail. We talk about it all the time. He closes those trades very quickly. His job is to hold those trades and capture the trends. And he made 124% from 20% of those trades being winners. I mean, that is what everyone should study as a force. But it says, I mean, volatility creates these opportunities. For trend followers out there, volatility is what you want because it creates outlier moves, and that's exactly what you want. So for me, volatility is great. You get big intraday ranges. We're just seeing the S&P futures trade on 109 point range, second highest daily range of the day. Great for the day traders. There's plenty to work in there. So it doesn't matter what your strategy is. If you're mean reversion, when you get range expansion, there's markets that can work in there. If you're trend following, volatility is really what you want to be doing. You're going to do better performance in high volatility markets. So I love it. Bring on the volatility, I say. And I think we are getting closer to that point.
We are. And one last thing. And one of the things about volatility that I've learned over the years, trading not only for myself, but trading on more of an institutional level and for high net worth individuals over the years, is that when you have volatility, it gives you some room for error. If you make a mistake, it can allow you to wiggle and trade yourself out of it. When there's low volatility, it's very difficult to do that. And so bring on the volatility. I'm with you, Chris. Please do.
I'll just say this, but yeah, obviously, if we do see high volatility, it has massive implications for trading. It means, generally speaking, when you see ranges, you've got to trade with a wider stop loss. You're taking on more risk, so your position size needs to be adjusted to accommodate. So adapt to the volatility. That's all I'm saying, and stay in the game and thrive potentially. Anyway, let's go to That's the Setup, second section. I want to bring up cable, sterling against the US dollar. I haven't got a huge amount of fundamental situations to focus on. And why I've brought this up is because we are testing the bottom end of the range. And why I brought the weekly chart up is because if you look at the Bollinger Bands, which in this case uses the 20-week moving average, and looks at a 2 standard deviation move at either side of that. So it's a form of realised volatility. It just shows the extent of the price moves away from that average. And as any statistician will tell you, 95% of outcomes are contained within 2 standard deviations. So that's really what the Bollinger Band tells you. And what we're seeing there is the Bollinger Bands have contracted on the weekly chart to the narrowest range. Get this, 1977, Blake. Now, in my so what you're seeing is a real compression of volatility. Those price moves are coming right down. Think of it like a coiled spring. The longer that goes on for, generally speaking, the more pronounced the move's going to be. And given that we're testing the bottom end of the range, one's got to ask, where is the likely direction? Because obviously volatility doesn't suggest the direction, it just tells you that there could be a breakout in volatility. I suspect the risks are to the downside, but what you're seeing now is really compressed price action for a period of time and testing the low end of the range. It feels like there's a big move coming. It feels like it's probably lower, but we wait for that range breakout. How are you seeing it, Blake?
Well, if you know anything about me and you followed me on social media for years, I've actually got a video that I posted called the laptop toss, and it's because of my loathing hate of the sterling and how I trade it sometimes. And I actually got stopped out of a short last week. So what I'm looking for personally, give me a good daily, weekly close below 125. And I'm with you, Chris. I think that you said 1977. I was just a wee little lad. I think I was playing around in the dirt looking for earthworms around that time in my life.
You weren't looking at Bollinger Bands.
Yeah, that's some really tight Bollinger Bands. So anyway,
right.
Look, 125, I'm with you. You get us a daily, weekly close below that. Maybe by the end of the week, we trade below 125. I think you can start looking for the low 120s. So
so we're just seeing a massive contraction in ranges, and that could be a precursor for a breakout. That's all I'm saying. Now we're trading at the year-to-date lows, the bottom end of the range. I think a weekly close, certainly daily weekly close below the bottom end of that range. I think that could be the start. I mean, we don't know. Of course, we never know, but it could be the start of a trend, a bearish trend setting up in cable. So one to watch, one for the radar.
Yeah, I like it. All right, next setup is going to be the S&P. You know, last time I brought the S&P up was probably a few weeks back, and I was doing the anatomy with this chart, the anatomy of a blow-off top. I'm happy to actually report to you guys that we have not seen a blow-off top. We've seen, range extensions, new channels develop. We hit the 100. We hit like some levels that we stopped making higher highs. Now we're starting to make lower lows. So we're now at channel support, and channel support comes in right around 5150. Depends on what you're looking at. If you're looking at the E-mini futures or a CFD, just you can see we're at, and you notice the 50 DMA comes in just a little bit below where we currently trade. And we start trading below that 50 DMA. I think it opens us back up to a retest of the previous channel, which is the green line, which is also near the 24% retracement of this entire move up. So I think based on what we said earlier today about volatility, saw the move index, you saw the VIX is starting to spike higher. We start getting below the 50 DMA. I think it opens up, and it's a setup for a little bit of a retracement, move back down towards that green line, or maybe the 24, or maybe if we get lucky, the 38% retracement. Still keeping the uptrend intact, but maybe a bit of a retracement. How are you looking at the S&P here, Chris?
Yeah, I think if we get a break of the 50, that would be, that's been a good trend filter. That would give you a move down to the former uptrend that's been in place. We've had the really strong rally on concentrated breadth. Obviously, the Mag 7 pushed us into highs earlier. Recently, we've seen big rotation. Value seems to be working a little bit better. Energy's on fire at the moment. Banks have done a little bit better if you're going to look at the XLF ETF. So it's been a bit more of a rotation, a bit more breadth that's played through. The question now is are we going to get into the next stage, which would probably be some sort of drawdown playing through. We're not giving up on this market yet. The Fed put is still there. The Fed is still obviously signalling that they've got a bias to cut rates, and that is still supportive of equity more broadly. And Nvidia's had a rally last night. It's interesting, Blake. Yeah, the market was down, 90 basis points or so, despite a massive sell-off in the fixed income market and a rates repricing. But Nvidia closed higher, Amazon closed higher, Meta closed higher. Things are still working. We're not giving up on this equity story yet. The time to be shorting markets, especially like these S&P or Dow or NASDAQ, are when the bid completely comes out of the market, because there's so much why would you buy when you can buy prices 5% lower? When the bid comes out of the market and you get a buyer's strike, that's the time to be shorting. We're not at that point yet, for sure.
Right.
My turn. Let's go into the crude market, because we are watching geopolitics. I'm not an expert in geopolitics. No, I'm not sure many people are. Very, very difficult to price risk around geopolitics, but we have seen A lot of headlines recently about the US saying that we are potentially seeing an imminent strike by missiles or drones from Iran on strategic Israeli bases, be it government or military bases. So we're on the watch out for lookouts for a potential reprisal from the Iranians. What that looks like and whether this creates a further sort of in concerns around broadening of the conflict is obviously yet to be seen. I think one positive for risk is that the Iranian officials have said that they will not touch the Straits of Hormuz at the moment, which obviously is a big cargo port for oil and LNG, one of the biggest in the world. And if that was to be impacted in any capacity, then crude prices and LNG and natural gas prices will spike. But what we're seeing now, technically, if we go on this, and I do think it's important, and maybe I should have used Brent crude because that's your barometer, is we broke out of the sort of bull channel that been playing through. We're back testing that former level now as well. The question is do we use this now as a stage to push higher as sort of more geopolitical headlines resurface? How are you seeing the crude market, Blake, at the moment?
Well, first of all, I want to tip my hat to you, Chris, because I remember a month ago when you brought up this chart, you put on that channel, and I don't miss a lot of basic technical analysis things. Usually they're very obvious to me, but for some reason I missed that one. You had it, and I'm like, oh, Chris, you're looking at it the way you should be looking at it. Well done. And crude has been following that channel. We broke out, and what we're doing is we're nudged on the breakout point of that channel. Well, it also resides, this $85 level resides right around the 618 key Fibonacci retracement, and that would be from the highs back in October of last year. Basically your entire chart that you see here. We're stalled at that previous 618, which tells me that we still have room to go up to $89, which is further than where we're at right now. So I think while we stay above $85, there's zero reason to be on the short side. We get below $85, maybe things are calming down from a geopolitical standpoint.
I think you're on the money there, to be honest. I think the greater probability is we see higher upside. It will be a political issue in the US, I think, through the election. And I think also, going back to the inflation thematic that we've debated earlier, energy, that this will feed through into higher energy components within the CPI basket going forward as well. I think if we were to break, may create a higher high if we get into $90. We talk about gasoline and various factors as well. I think this is going to be something that will lift the energy component of CPI at a time when it really doesn't need to happen. So again, higher interest rates, higher oil prices. It just further mitigates the need for any kind of near-term rate cuts.
Well, speaking of geopolitics and something that may have been one of the drivers behind gold, let's talk about the last setup, which is gold. Gold it's been absolutely spectacular. It's been a breakout du jour. I think anybody who's long gold and precious metals, especially if you have physical, you're happy about it. But the question is, do we start chasing at these levels? It's interesting. As of a couple of days ago, I started getting text messages from people that know nothing about the markets that are actually out physically buying gold. I've had a number of people
from Walmart.
They're out there saying, hey, I'm doing adult stuff. I got a text like, I'm doing adult stuff, buying these gold bars. And I'm like, oh, okay. Anyway, if you look at it technically, gold we had this range between, it was about 2080 was the highs, down there towards the lows in 2022. We had this big range that we had a triple top. We finally broke out and took off. Well, that entire range, the 161% extension, comes in right where we're at and where we've been for the last 2 days. Relative strength is very overbought. It's starting to roll over. We just completed an equal leg move. You can see it in red. I'm a little nervous here. I don't think gold, and especially given what has happened with the dollar today, I don't think you should be shorting gold, but I sure as heck would be very careful about chasing gold at these levels. What are your thoughts about gold where we stand?
Well, I mean, it just goes up on everything, right? You've had this gold going up on real rates, moving up. It's been following. Actually, statistically, it's had a strongest correlation with Brent crude. So I think there's probably an element of buying for geopolitical hedges. And I think probably the thing that hasn't really happened so far, unlike Bitcoin, is that you haven't really seen inflows into gold ETFs, be it the GDX or the GLD. So that's the next leg, is big inflows into the ETF scene, which would push the gold price higher. But yeah, I agree. These levels are not for chasing at the moment. It's grossly overbought, short-term overowned. I want to see some heat coming out. But I will say, I mean, it's strong for a reason right now. And probably, the thing that I talk about with Michael all the time, Michael Brown, is that gold is the Mac Daddy. There is no market out there that is more of the king of this situation, of people going, gold's rallied, why? And we have to pick a reason for it. Is it an inflation hedge? Is it against economic fragility? Is it against geopolitics? You've got to pick a reason after the fact. What you've got there is a chart which aggregates the flow, behaviours, hedging activity, speculative activity, all into one thing. That's what we trade. It doesn't matter why it's going up. You can pick a reason after the fact. There's a good chance you wouldn't have picked that reason before it rallied. All that matters is price. We're slaves to price, and it's strong for a reason at the moment. But right now, I wouldn't be chasing it. I think it's too hot. I like it higher over time. Don't get me wrong. I think that the higher probability is in a month or 2 months we'll see it higher than these levels. But I'll be waiting for some of the heat to come out. That's the way I see it.
2250, 2275. Those are the levels I'd be looking for. So.
I think that might be a bit too much of a pullback. I think but yeah, I do think it's some of the heats needs to come out for sure, and I'll be looking at longs, but I think it's tough to short as well. Anyway, let's go to play of the day. We're both hitting a Swiss vibe today. I'm going for dollar Swiss, and if we can bring up a quick cheeky look at the chart, look, it's going up. That's enough reason to buy it in itself. But we don't get the next central bank meeting from the Swiss doesn't come until June. They work on a quarterly basis, but they'll cut rates in that meeting by another 25 basis points, if not more. As I said, there's. We're seeing exceptionalism in the US. We are seeing classic policy divergence between these two pairs. The Swiss have been proactive. They are still selling their currency. So they're buying they're trying to weaken their currency coming forward. So they want to see a weaker Swiss franc. They've been proactive. They want to see weakness playing through in their currency. At the same time, the US dollar is starting to emerge as the kingpin FX play once again. Market's already anticipating that. So you've got momentum working well. You've got policy divergence working 101. It almost feels too easy, this trade, which probably is why it wouldn't work, which is why you want to look at your stops very closely on this. But right now, you've got probably the clearest policy divergence that's brewing between central banks. One wants a weaker currency, the other's not too concerned about it, and is probably unlikely to cut rates anytime soon. And you've got the trend and the technicals working for you in this situation. So I like this higher, Blake.
I'm going to have to echo your thoughts with the Euro Swiss, and that's going to be my play of the day. Which I'm down with making some Swiss cheese with you, because I'm going to back up the truck here on the Euro Swiss on any dip back down to 97. It's interesting. I pulled up this chart. You might remember this chart, Chris, from back in January. I said a Gartley could turn into a butterfly. The butterfly target was 98 cents. I left the chart the way it was the last time we visited this chart back in February. We hit 98 cents. We actually hit closer to 99 cents recently. ECB is tomorrow. I'm really hoping the ECB might. I don't think they're going to be, as I told you earlier, I don't think they're going to give us too many clues, but maybe they are dovish. And if they are dovish and that opens some downside down to 97 cents, that's where I'm a buyer also. And I'm not long anymore. I got out like a week and a half ago. The trade I've been in most of 2024, actually all of 2024 now I'm thinking about it. But I am looking to back up the truck on any dip. We also need to talk a little bit about geopolitical risk, because if there is a geopolitical flare-up, the Swiss franc could capture a bid very near term. That's one of the risks that are on the outside periphery of what we're doing right now. But if there is a geopolitical flare-up, Swiss franc could benefit from that. But
would you rather own of all the sort of anti-cyclicals? Well, the US dollar's not an anti-cyclical, but if you're all the safe haven, would you rather own US dollars, yen, or Swiss franc if we were to see a proper market getting properly concerned about the geopolitical issue?
It'd be right in that order: dollars, then yen, and then Swiss francs. So I think Swiss franc would be more of a short-term bump, but then, dollars would overtake for safe haven, and so would the yen, as the BOJ is trying to reverse its monetary policy of 20 some odd years. So, well,
let's hope for the sake of humanity that's not going to be the case, and we do see a simmering of issues on the news flow. Anyway, thank you, Blake. You're an absolute legend. Superstar views, and thanks for everyone who's been watching this at home. If you hadn't stopped watching it all this through, smash the like button. We really appreciate this. Share this with your loved ones, your family, or your friends, and let people know what's going on with the trade-off. And we'll see you back next week for more of the trade-off.